Good afternoon and welcome to the MERCIA Asset Management PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And now I'd like to hand you over to Mark Payton, CEO. Good afternoon, sir.
Thank you. Good afternoon and welcome everybody, and thank you for joining both Martin and I to present our FY25 preliminary results. And for those that have travelled to Birmingham New Street, you'll recognise Ozzy that sits in Birmingham New Street, and Martin and I are coming from our Birmingham office today. Just as introductions, I'm the Chief Executive, co-founder of MERCIA, approximately 15 years now of commercialising technologies, but more importantly, investing into businesses, growing businesses, and either exiting them through IPO, but more often through trade sales.
Yes, good afternoon, everyone. I joined MERCIA over 10 years ago now to float the business with Mark when there was just a small handful of us. MERCIA is my fourth listed company as CFO, and most of my career has been spent in and around technology-related businesses.
Thanks, Martin. So today we'll talk a little bit about MERCIA, our model, the market opportunity that we're facing. Martin will give a more detailed review of the finances of the group. We'll talk about the progress over this period and our outlook, and in summary, for the group going forwards. So for those that have not heard of MERCIA, what is MERCIA? Well, we are a fast-growing, scalable alternative asset manager. We're one of the leading providers now across the UK, aiming to see and source deals that others don't necessarily see. We focus exclusively on the UK, where there are multi-billions per annum invested, and we look to private capital deployment through debt and private equity, what we term together as development capital, property finance, and venture, and moving the group now towards real assets in parallel rather than instead of. We have been building over the last 10 years a highly differentiated deal origination platform to see the best deals and win the best deals, and that's through our footprint across the UK and our regional offices. Now, with the growing and increasing opportunities that we're investing against, we are now building a sales and distribution platform across retail and predominantly now across institutional investment. Martin mentioned joining us 10 years ago, and this is very much a sort of 10-year celebration actually on AIM. And at the point when we started MERCIA, and that was 15 years ago now, it was really to address this observation. And these are the most recent results from 2021, where 12,600 high growth businesses in the UK, 21% of those are based in London. However, somewhat alarmingly, 66% of all capital deployed are into those 21% of the businesses, those high growth businesses. And high growth is defined as growing at 20% growth in employees per annum averaged over 3 years. And so why is that? And our strong belief then, as it is today, is you've got to be physically based where those opportunities are. And we've got offices across the UK, you can see where they're there. And we are sourcing about 90% now of our investment transactions are outside of London. We do have a London office, we do transact out of our London office, but we are truly pan-national. And this shows the pace of growth of the group. So financial year 25, this reporting period, has been the strongest in terms of capital deployment that we've made, £284 million. You can see the red dots on the left figure there, where those transactions have occurred across the country. 131 million into venture businesses, and of that circa 10 million into our direct assets, and I'll talk to those later. 72 million into development capital and 81 million into property financing. And we've backed brands that some of you will be familiar with, but when we backed them, they were unknowns. Kirsty's, and you'll see those, they're gluten-free, dairy-free products. You'll see them in Asda, Tesco, Sainsbury's, they're in most major supermarkets. Oddbox, pure pet food based up in Newcastle. Harrogate, Springwater, we've lent money to repeatedly over the past. And the other names there that you may not have heard of today, you will do over time as they continue to grow. So a really strong stable of businesses, a majority of those out in the UK regions. Last year, we started our 3-year plan, which we termed MERCIA 27, where we said we would grow assets under management over 3 years from 1.8 billion to 3 billion. We would grow EBITDA from 5.5 million to 10 million and grow the EBITDA margin from 18.2% to 26%. And as you may have seen with the results today, we're very pleased with the progress, and we are more than capable of achieving this 3-year objective across these 3 areas. We're at 2 billion now in AUM, 7.6 million EBITDA and a 22.1% EBITDA margin. We also made a commitment last year to look to divest up to 70% by value of our direct investments as we look to simplify the business as a focused third-party fund management business. Now, we said in this financial year gone by that we would not expect any exits, and that exits will start to appear at the back end of FY26 and into FY27. We don't change that position in terms of our belief in the exit timing, but during FY25, we did experience a small investment, one of our smaller businesses in the portfolio, which generated a return of £600,000. Other key milestones within this financial year include the appointment of Dean Heaney as head of institutional distribution as we look to grow our institutional base. And on that basis, we've closed our first, we've had the first close of our new £82 million institutional fund, MERCIA Evolution Fund. We've seen third-party capital raises across the 3 discrete pools of capital we manage: retail, institutional, and public sector, which is predominantly British Business Bank for us. And that collectively has resulted in net fund inflows of circa 15% when looking across the financial year and into the tax year end to the 5th of April. As I've mentioned, we've had a record deployment of £284 million into 165 businesses, and importantly, 87 of those new to house. And the opportunity we face is driven by a number of features here. 9.1 trillion in investable capital is held within the UK, predominantly invested overseas, circa 2 trillion of that being retail capital. A number of you may be familiar with the Mansion House Compact and the Mansion House Accord. The Compact was a statement of intent to turn DC pensions towards putting 5% of their growing allocations to domestic basis into the private capital markets. The Mansion House Accord builds on the Compact, with 17 signing up across the pension and insurance industries. And this combines really with Solvency II Act changes, Solvency UK reforms, and also a growing emphasis on place-based impact investment. And we're seeing that particularly with the local government pension schemes. And also new structures brought in like LTAFs and certain platforms allowing funds to access a diverse portfolio of assets, but always pointed domestically, always on a regional deployment basis as well. And we're extremely well placed. And put this into context, the 5% growth in terms of redirecting capital into the UK is estimated to be at least 16 billion in value by 2030. And the remarkable thing here with the UK is it's the second largest behind the US holder of investable capital, and actually accounts for about 8 to 10% of the global capital comes from the UK. So you can see why reforms and interest are there to redirect capital into the UK, into the private markets. And as a regional based investor, we think we're extremely well placed for those tailwinds coming.
Thank you, Mark. This first slide in the finance section summarises our financial performance for the year ending 31st of March 2025. As you can see, we've increased our revenues by 13% during the year and our EBITDA by 37%, showing the economies of scale that MERCIA is now achieving. Our progressive dividend policy started in 2020, and I'm pleased to say that our board is recommending a proposed final dividend per share of 0.58 pence, just over a 5% increase on the prior year. We manage our business carefully, and at the year end, we retained 40 million of cash and no debt. Our net assets per share have nudged up during the year to 43.6 pence. And at the end of the year, we are now managing 2 billion of assets under management, which I'll speak to in more detail shortly. During the course of the financial year and the 5 days up to the tax year end, we achieved inflows of £316 million. And at the end of the period, we have £640 million of dry powder. This slide shows our sustained organic growth during the year in revenues, EBITDA, and operating cash generation. Starting with the first chart on the left, you can see the growth there in revenues, and we are managing to maintain our 2% blended fee margin across our asset categories. All of this revenue growth was organic. 81% of our revenue comes from our fund management operations, our contracted revenues being fund management fees and also director monitoring fees. And the remaining 19% comes from transaction-related revenues. Of our total revenues, 98% is now coming from our fund management business, and only 2% is coming from our direct investing balance sheet activities. Looking at the EBITDA performance and the growth in EBITDA, which is up 37%, I think what's interesting is that over the last 2 years, we've grown our assets under management by £600 million. And that is what is helping to drive now the economies of scale in our business. And of that 600 million growth in the last 2 years, what I think is quite interesting, showing the evolution of the balance of our asset classes, is that 47% of that 600 million was new equity inflows, but 53% was new SME lending inflows as well, showing again, as I've said, the maturing and the diversification of our asset classes. And over on the right-hand side, you can see that not only are we generating growth in EBITDA, but we are turning that EBITDA into cash. And for the second year running, our cash generated from operating activities was higher than the actual reported EBITDA. Against a continuing challenging market backdrop for many asset managers, this slide shows our growing assets under management with 237 fund inflows during the financial year and a further 79 million just after the year end. There were no redemptions in any of our mandates at MERCIA, and the only reductions in AUM of any magnitude was distributions to our many MERCIA stakeholders, which includes the shareholders of our 3 Northern VCTs, our LP fund investors, where we are making investment returns to the LPs, and of course through dividends to our existing shareholders. This slide provides more granularity on the makeup of our assets under management by asset class, investor type, and fund type as at the 31st of March. And combined, these typically long-dated or evergreen funds are generating, as I've said, that fee margin of circa 2%. And that is across 67 fund mandates that we are now managing. And the breadth of those mandates means that we are increasingly able to either equity invest or lend throughout the United Kingdom. This slide shows our consolidated profit and loss account, and I think there's 2 or 3 important things to draw out here. Firstly, I think what's interesting is that whilst the revenues of the business grew by 4 million, the cost base only grew by 2 million. And there is the example of economies of scale where we're able to now drive the top line, but the growth in our cost base is much lower than it has historically been when we were managing lower quantities of assets under management. I think the next thing to note is that the finance income remains strong. Most of that finance income line is deposit interest on our 40 or so million pounds of cash on deposit, and we've been earning during the past 12 months circa 4.5% with our money on deposit. I think the next thing that's quite interesting is that for the first time, not the only time, but for the first time in a few years, we've earned performance fees from managing the 3 Northern VCTs. We did earn significant performance fees in the early years after we acquired the VCT contracts. And it's pleasing to see that the performance of the VCT NAVs has now resulted in MERCIA once again being entitled to a performance fee. Of that performance fee, we've agreed with the VCT boards that we will distribute 80%, including employers NI, to the VCT investment team who are managing the 3 Northern VCTs. Thank you. This next slide is our consolidated balance sheet. And as you can see there, there's the strength of the balance sheet through principally the direct investment portfolio at 126 million, which Mark will talk to shortly, the 40 million of cash, and overall a very strong balance sheet at 188 million. And what that is enabling us to do now is not only to increase the dividend, but also to announce a new policy, which is an annual £3 million share buyback, where shares bought back will be cancelled from this new policy. The next slide is our consolidated statement of cash flows, which is a very simple cash flow statement. I'm pleased to say you can see there the top line, 8.7 million generated from operating cash flow. The 9.7 million pounds invested during the year in that direct investment portfolio, a considerable reduction on prior year as the portfolio continues to mature and therefore require lower levels of investment. We said at the start of MERCIA 27 that we anticipated the balance sheet portfolio needing no more than 25 million over the next 3 years. And as you can see here, so far we've invested 10 of that 25 million, and we still anticipate the portfolio over the remaining 2 years requiring no more than a further 15 million pounds. Also on this slide, you can see the interest received from our cash deposits, the full payment of the final deferred consideration on the acquisition of Frontier Development Capital, which is continuing to perform extremely well, dividends paid in the prior year, and the final purchase of the original £5 million share buyback. One of the things we're focused on as a board with our capital allocation policy is carefully monitoring how we are enabling increasing shareholder returns. And one way of looking at this is to calculate a theoretical return percentage known as the weighted average cost of capital. Not easy to do when you have no debt on your balance sheet, but nevertheless, we've applied the calculation and we've come up with an approximate weighted average cost of capital of 9%. We did ask ChatGPT what it thought our WACC should be, and ChatGPT's response was 10. So I think we're in the right ballpark. The important point about this is it sets a benchmark or a hurdle above which what we do with our shareholders' money, we should be exceeding that hurdle. And down below in this slide is the example of our 3 acquisitions to date since our IPO. And you can see there that the return on invested capital thus far from each of the 3 acquisitions exceeds our weighted average cost of capital. And that's really important, because that's what that is telling us, is that the investments we've been making of shareholders' money into these acquisitions is paying dividends. Thank you.
Thank you, Martin. So the next handful of slides will just reflect on the progress of the group and the outlook going forwards. As I said at the very beginning, this is 10 years now on AIM, and every 3 years the group has grown by circa 100%. So fulfilling the growth aspirations of MERCIA going forwards for the MERCIA 27, I think fits very neatly within that paradigm. On pretty much every metric that you want to look at, whether it's third-party funds growth from 23 million to 1.8 billion, revenue growth, profitability growth, you can see strong growth throughout the group. I think quite importantly, as we start to benefit from sort of scale economies, another piece that we're doing is we are writing larger checks. So investing larger amounts of capital, which requires the same amount of resource utilization, is a great way of driving efficiency and productivity through the group. And the other piece to pull out from this is the fact that when Martin and I were on the market, when we were basically raising our IPO capital, the 70 million when we came to market, there was a degree of cynicism seen that the reason why there's no money chasing deals in the regions, there are no deals worth doing. Well, I'm really pleased to say 10 years later, and this is just from equity realizations, we have returned over 800 million pounds back to our balance sheet and our managed funds, clearly demonstrating as the fact that 85% of what we do is outside of London, outside of the southeast, that there are returns to be made outside of that area. And then just onto the balance sheet direct investments. Here they are listed by value, by our holding value. You can see on the left, you can see the date when we first made the investment, and then the starting position. So 117 million at the start of this financial year, 9.7 million invested across the portfolio. The realization of the smaller investment there, Artesian, bringing back £601,000. Realized gains and losses. We have a realized loss, which was Sherlock Biosciences. So that's moved the 340 out. And then the fair value movements across the direct investments, the ups and downs pretty much cancel each other out to sort of close out in a 274,000 position. Then what that means is the closing position for the group of the direct investments is circa 126 million at year end. I think finally on this table is the important observation about the size of the equity stakes that we hold in these businesses, typically ranging from 20 to 40%. But all of these businesses also have MERCIA fund positions in them. So often our holding in these businesses across the group is over 50%. But our influence, albeit very strong, our control is non-existent. We do not control these businesses. We have board seats on most of them, and our influence is very strong. And that's important when we think about the balance sheet unwinding over time during this MERCIA 27, and adds credibility and credence to that moving forwards. These are our top 10 assets by value. So Netasia is a Manchester-based business in revenue growth. It's bot detection. So bot detection and mitigation sits on customer side, server side, with some very well-known blue chip clients. VoxPopMe is a video analytics for the market research arena. That's in revenue growth, just moving to break even. That's a business based in Birmingham with a US operation. We've got Warwick Acoustics, which is working within the automotive sector under OEMs, looking at integrating its speaker technology, which is lightweight, flexible, low energy electrostatic speakers. And that is about to be rolled out into the first automotive partner, and we expect that in September. It's also got a high-end headphone set, which is in strong revenue growth. And that business is in revenue growth as well. The Cards, the Universe and Everything, that's based just outside of London. That's a virtual trading platform. It's got 2 games now. It's in revenue growth, just under break even now. MedHeron has got a significant partnership with Bayer, is in revenue generation with that partnership. It's also got its own program of development, which is a testosterone patch addressing the HRT arena. That's a business based in Coventry now. IOTO based in Birmingham. That's got a remote split lamp ophthalmic application. That business is progressing well now, actually, and making early sales. And that's one, just reflecting back a few years, we took a heavy provision and restructured that business, and that business has come out repointed now in a much better direction. Invincible Studios, Soccer Manager. This is a football management platform on a multi-platform focused predominantly in the mobile space. That's in strong revenue growth and is profitable. Locate Bio, this is the one asset actually here that fits outside of the MERCIA 27. This is a much earlier business. It's developing a bone regeneration product. It's yet to go into the clinic with that. And we think that that's a longer journey. So it falls outside of the MERCIA 27 scope. That's a Nottingham-based business. Intelligent Positioning, which is a SEO platform that's in revenue growth, is now at cash break even and into profitability. That business is based in Brighton. And then the final one is a business called Aonic, which acquired Endreams a little while ago. And this is the residual stake that we have in this business. Now, this business is growing strongly. It's a PE-backed buy and build gaming business. It's a highly profitable gaming business. And we'll be looking at a IPO when the market's open. And it is the one business in this particular piece that is dependent on the public markets opening. That happens when we will look to take out our position. All of these businesses are under advisement. Locate Bio is the one business, as I said, falls outside of the MERCIA 27 arena. The other businesses that we have advisors supporting us to look to move these businesses out and divest those businesses within the next 18-24 months. We really do seriously consider ourselves as a responsible investment with sustainability at the heart of what we do. And for us, sustainability is progress and scale and frankly doing the right thing. And for this is quite a key differentiator and an important part for our institutional funds that are with us and the ones that are looking to back us in terms of new funds under production. They are seeing this as a very key metric to measure the managers that they want to support. We have Bansi, who's joined us as a dedicated sustainable manager, and she is integrating all elements of ESG from our deal origination through transactions, through business development and exit. We have a number of bodies that we're a member to. I'm a great believer if you measure it, it happens. Just to pull one of those out, which I think has been great progress, is one of the early ones that we committed to, which was investing in Women Code. And that's where we've been developing talent within the business ground up, but also on a senior level, making sure we have the talent coming down So if you look at our board, half of our NEDs are women. If you look at the execs, a third are. The executive committee that runs and delivers the strategic plan that we've been talking about, 50% women. In total, 40% women. So for a financial services business, that's great progress we're making, and we're making great progress in those other areas as well, which is critical in terms of winning new fund mandates and winning new funds. And this really reflects us in this axis here, where we're seeing strong growth in terms of our assets under management, which are predominantly funds under management. And so when we use the interplay between AUM and FUM, so FUM is third-party capital we're managing, AUM is then the addition of our cash, our balance sheet direct investments, and our intangibles. So that's the delta between AUM and FUM. So of the 2 billion that we have in AUM, 1.8 billion is in third-party funds. And we see that growth metric continuing. So as we go towards the 3-year plan and the end of the 3-year plan, 31st of March 2027, you can see growth across those assets, but predominantly driven by real assets, which would comprise of institutional and retail investors. So just in summary, and I hope you agree with us, is that we are very much right place, right time. There are strong domestic growth prospects across the UK, as well as on a regional basis within the private markets. And we just see capital coming towards this space. We're highly diversified in terms of deal origination, in terms of asset class, and importantly, in terms of investor type. The revenue is predictable and recurring, circa 80% recurring, and we benefit currently from a blended fee margin of circa 2%. But importantly, as we look to our shareholders, and we're very grateful for the support we've received over the 10 years, we are looking now to increasingly return back to shareholders through our progressive dividend policy and through the commencement of our annual buyback. Thank you very much for your attention.
Mark, Martin, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Sorry, I don't know why, but I have no questions on my screen, and I know there will be questions. I'm just looking across at Martin's.
Yes, I can only see actually one question, which is in relation to the VCTs, which says you generated performance fees from the VCTs for the first time. Actually, this year isn't the first time, as I mentioned earlier. We did receive actually in total 6 million of performance fees in the early years after we acquired the VCT contracts at the end of 2019.
And just while, hopefully this can be sorted out so we can see the other questions. We just can't see them, sadly. But we had 2 questions submitted to us, which was how is MERCIA using AI, and what is MERCIA's approach to sustainability, and is it helping with fundraising? So in terms of using AI, I think the first is a one-word answer, which is carefully, is we are using that. So we're using it on 2 broad approaches. So we have quite a sophisticated outreach mechanism where we're reaching out to potential investees and prospective investees, and that is working extremely well, actually. And the other piece is within our own data. So it's a sort of tenant basis where we're basically ring-fencing our own data and using that to interrogate via a large language model and Copilot. So that is the way we're using it internally. And that is really to use the vast amount of data that we've accumulated over a decade through various systems, but to ensure that it remains proprietary, because I'm sure many of you know that the moment you take it out to a chat GPT or something, it goes into the public domain. And that is not good for one's proprietary data. So yes, we are using AI. We are using it very carefully, and we see its opportunity and strengths with us and with our portfolio. We do a number of seminars with our portfolio, and internally we do that as well so that we can get up to speed with the right application of it. And then in terms of the second question, which was what's MERCIA's approach to sustainability, and is it helping us with fundraising? I'm hoping that slide on sustainability that was on there, it is critical. So Dean, who heads up our institutional investment, has said very clearly that this is an important tenet of what we're doing in terms of going out and fundraising. We are monitored and measured, and we have detailed questionnaires from pension funds etc. about that, also from British Business Bank and also from intermediaries with retail. It's important, but it's something we do and we passionately believe in as well. And it fits very much with this sort of impactful investment, this place-based impactful investment that we are well known for in respect of commercial returns as well. There is no way we'd be able to manage capital without commercial returns.
Right, so I can now see the questions. So perhaps, Mark, if I may, I'll read them out to you in descending order. So the next question is, given your strong trajectory, how are you positioning MERCIA against larger asset management firms, and what do you view as your key competitive advantage?
Yeah, so I mean, it's really, I mean, I'm just going to step back from that question because we for the first time ever, we are having institutional funds reach out to us. So this is a new development for it, and this is, I'm sure, because of the Mansion House Accord and the Mansion House Compact, where there is an increasing pressure to deploy capital domestically. And if you're a local government pension scheme, that's not just domestically, that's locally. So there's increasing pressure in that respect. So yeah, we are often asked, are there other MERCIAs out there? And if you look at how many domestic focused regional managers are, there's only a handful. So the next point then is, so how much can you manage? And that's I think a really critical point, because as you get consolidation within this institutional sector, you'll get a requirement for new and larger funds. Now, LTAFs, which is a new product coming through, is enabling, if you like, the multi-asset approach of assigning pieces to different managers. And I think that is one solution. But the other solution is real assets. You know, a venture fund will only ever be, if it's domestically pointed, 1, 2, 300 million. Whereas actually you can go into real assets and you can go 300, 500, 1 billion. And that's why we anticipate that growth coming from real assets, is because a lot of this institutional capital will be looking for that more risk profiled approach that we do on a smaller scale, but on a larger scale.
So the next question is in 4 or 5 parts, actually. So if I may, I will read them one at a time. So first question is in relation to the investments post year end into, I think, Axis Spine and Warwick Acoustics. Were those recent funding rounds post year end at or above holding value? And did third party investors come into those rounds?
Okay. Well, the answer to that is yes. So we did have third party investors into those rounds, and yes, they were at the holding value.
Yeah. Good. The next multi-part question is, what's the pipeline in terms of new regional fund launches or new tranches?
So, and that's a really excellent question, actually, because it's really important. Now, for those that, like me, are obsessed with what's going on, I have to face in many directions. And what British Business Bank are being told by the government to do is really important to us, because we manage a big portion of British Business Bank capital, and we believe we could manage more. So there was a larger allocation through the spending group to British Business Bank. So it's not just about existing mandates. It's not just about the original allocations into existing mandates. It's about larger allocations into existing mandates, as well as new ones. And we'll see more and more BBB, like, for instance, the Evolution Fund. So the Evolution Fund has an institutional pension fund in it, but it also has the subsidiary of British Business Bank, which is BBI, that invested in. So we're seeing more and more of these discrete pools of capital moving together. And we would expect BBB to be more involved with retail, with family offices, with wealth managers, as well as institutions. So we are looking at increased allocations, not this year, but would be probably next year, into the recent fund mandate wins. And we are acutely aware there's at least 2 more geographies that are coming out on a regional basis for new funds going through. And we will consider those. And we will, of course, be looking. We are easily meeting our deployment targets for our regional funds. So we will be considering re-upping, if you like, getting new allocations within the existing funds. There are other conversations ongoing with BBB. We believe we can help them fulfill their mandate as they look to operate against these 8 pillars of the industrial strategy, pointing capital domestically and regionally. We think we're very well placed to help them.
Thank you, Mark. The next one is, does the potential consolidation of, I think here it means the local government pooled pension schemes, does that potential consolidation matter to us?
So it doesn't matter to us, because we have relationships with them individually, and those relationships will continue throughout that consolidation. it does speak to what I was saying before, which is bigger is better. And that's really at the heart of our sort of go further, go faster theme, because that's what we need to do. We need to grow as an asset manager, and we need to grow the size of funds under management, because there's one thing that's for sure over the next 5 years is the capital allocations to individual funds will grow too.
Next question is, how many of the direct investment portfolio are profitable and or cash flow positive?
So I will give the wrong answer if I say that, but of the 10 that, why did I do it like that? Of the 10, you have to forgive me, I'm just scrolling through the slides. So there were 10 that I highlighted, which were on slide 22. So MERCIA is loss-making, but it's closing the gap. Vox Popme is break-even. Warwick Acoustics is small, but loss-making. The cards, the universe and everything is basically break-even now. Medherent is loss-making. IOTO is loss-making. Invincible Studios is profitable. Locate is very young in its journey and is loss-making. Intelligent Positioning is profitable and cash generative, as is Aonic.
Great, thank you, Mark. So moving on to the next group of questions, if I may. With a significant number of portfolio exits, I think this is the balance sheet planned, what factors will most influence your decision making on timing and pricing for these divestments?
So all 20 have been reviewed. So what we did before, so just stepping back, so MERCIA 27 was a year in the making, if that makes sense. So there was a strategic review for the 12 months before, and part of that strategic review was to look with advisors at all of our portfolio companies and ask, when can we exit them? What are the metrics that will drive towards making these saleable assets? And that's why we arrived at 70%, not 100%, because clearly the timings, and Locate's a good example, clearly the timings of those would fall outside of that scope. From those advisors who are sector specialists who we have engaged on the portfolio, and it's back to our position as we have quite the influence on these portfolios, we have full alignment in terms of shareholders in these businesses, and we're working with management teams in terms of exit trajectories as well. We have a number of metrics. Some of them are ARR multiples, some of them are break-even multiples, some of them are, if you look at Warwick Acoustics, it's a case of one OEM delivering in terms of in-market supply, one OEM integrating. So there's a whole bunch of different metrics on that we're driving through. We are optimistic that we can move those through. The one that I guess is the one challenge is Aonic, because it's dependent on the IPO window opening, and that's something outside of our influence. As far as the others go, that's to do with commercial technical traction.
Great, thank you. Now I can answer the next one, Mark, which is a clarification request question, which is in relation to our assets under management and funds under management. So the question is, I think it was mentioned that assets under management have grown by 600 million and now sits at around 2 billion. However, according to your balance sheet presented, total assets are just over 200 million. Please, would you clarify these different numbers? Yes, of course. So when we talk about assets under management, that is the combination of our funds under management, which is 1.8 billion, and the circa 200 million, which is our consolidated balance sheet. The 600 million growth in assets under management I referred to on one of the slides is the growth in our assets under management over the past 2 years. So I hope that answers that question. The next interesting question is that growth is not translating into shareholder value accretion on a similar basis. When can we expect this to improve?
Yeah, and I think, I'm sure we've both got answers to this.
Yes.
I mean, I'm a founding shareholder. Martin and I have invested repeatedly in this business out of our own money in that respect, because we passionately believe in this business. The point now is, now that this business is cash generative, profitable, scaling, and I think attracting attention, it is up to us now to do what we can with the resources we have available to look to correct that share price. Part of that is profile raising, part of that is getting out into the market, part of that is our progressive dividend policy, and part of that is our buyback. So we have a concerted effort this year to make sure this business's share price is what it deserves.
Yes, and if I may also just add that since we started our progressive dividend policy, and including the buyback, the 5 million buyback that we did last year, we have already returned 20 million to shareholders. So the next question is, what scope is there for further VCT management mandates? I think this is, would we seek to acquire any further VCT mandates?
And this is, and I get why this question comes forward, and this is a question I've heard before. The challenge is, for those that aren't completely familiar with VCTs, is there are a number of restrictions and rules that wrap around them. So having multiple contracts doesn't help in respect of that. So in other words, one of the rules is you can only invest 20 million into the recipient. So the investee can only receive 20 million from a VCT. And the more VCTs you have, and if you're doing a sort of, often managers do, if you're doing a sort of deal sharing basis, then the smaller the tickets are that are going into that. So some of the rules restrict the realistic scaling of those to the advantage of the existing incumbent investors in the VCT. So we're not doing it. Fundamentally, at the heart of everything we're doing is we must make money for our investors. And if for whatever reason it's not working out, we will do corrective action to make sure it does work out. And so we're not chasing revenue and profit per se, which you could do if you went to try and consolidate the sector, because I think it would be at the disadvantage of the incumbent VCTs. So it's not to say never, because you can never say never, but it is not on our radar to do.
Yes, and I think it's also fair to say that we would not do so if there was a sense from our VCTs that they didn't feel that adding a further VCT mandate was in the best interests of the existing VCT shareholders.
Absolutely.
So the next question is a question around our share price performance since our IPO. And the question says, since you floated 15 years ago, it was actually, the original MERCIA was founded 15 years ago, but our IPO was actually 10 years ago. And I note that the share price has roughly halved, slightly under that, over the period. And what do we think are the main drivers of that? And so why is there a disconnect between MERCIA's increasing financial performance and the share price reduction since our IPO? Now, I can start off with that,
please do,
Mark, if you'd like me to. So if we go back to 2014, I think there were a number of balance sheet investment models on the market at that time. And there was an overarching belief, I think, in the intrinsic value that existed in those balance sheet portfolios, university spin-outs, etc., the likes of IP Group, Touchstone Innovations, Allied Minds, and a number of others, some of you may remember. And therefore, the share prices of many of those companies, including ourselves after we floated at 50p, were sitting at a premium to our net asset value. And then as we went through beyond 2014 into 16 and then into 17, what we saw was a number of those models imploding, unfortunately, Allied Minds being the first of the larger players to do so. And then a merger between Touchstone and IP Group, and the reduction in value creation, significant reduction in value creation that unfortunately created. And understandably, the market then began to become skeptical that rather than there being an intrinsic underlying value in these balance sheet portfolios, actually, there was an underlying risk in these venture loss-making portfolios. And therefore, the market moved from holding those shares at a premium to NAV to moved into a discount to NAV territory. And then in the subsequent years, again, quite understandably, that skepticism has only increased as a number of those balance sheet models have suffered significant reductions in their reported NAV per shares. So I think we have been caught in that sentiment, notwithstanding the fact that actually our balance sheet portfolio has performed extremely well during this 10-year period. So I think that is part of the backdrop. I think it may also be possible that how do you value MERCIA when it's really two businesses in one? And I think we've had that feedback as well, understandably from our shareholder base, which is, are you a balance sheet investor? Do we value you on a discount to NAV per share? Or are you a profitable fund management business where we should value with a multiple of your EBITDA and of course, and your cash on your balance sheet? And of course, the answer is we are both. But what we are now trying to do, as you can see, is clearly be an asset manager based on our funds under management, which is why part of the reason why we are divesting that balance sheet portfolio and turning it into cash. So it will become easier and easier to value MERCIA in the future based upon its EBITDA performance.
Spot on.
So I hope that didn't take too long answering that question. The next question is our 2% fee margin sustainable? So I think the answer is over time, less likely, because inevitably when you're moving into real asset space, fee margins are way below 2%, and sometimes they can be below 1%. However, I wouldn't be too worried about that because what comes with large fund mandates is increasing economies of scale. So to the extent that our overall blended fee margin starts to dip below 2% over time, I do think, as this year's results have demonstrated, I think that we will continue to see benefits of economies of scale, which will still continue to drive the bottom line. The next question is, it's a follow-on related question apparently to an earlier question, which is, would we consider publishing net asset value data per share to allow investors and the market to assess whether the shares are undervalued, overvalued, or fairly valued, as is done by investment trusts? Well, we do obviously publish our NAV per share every 6 months, and we do have our interim results reviewed by our auditors, even though we don't have to. I think we aren't an investment trust, and I think to do so we only actually value our balance sheet assets once every 6 months anyway, and I don't think to do so, monthly or quarterly would be appropriate. I think we're nearly at the end. Thank you everybody for bearing with us. The buyback is welcomed. Thank you. Its quantum seems a little unambitious. The direct portfolio requires circa 10 million capital this year, and you're looking to exit 70% in short order. Could you not have upscaled the buyback facility? It is only an upper bound after all. So shall I?
Yeah.
Okay, so I'll start with that again. So the 3 million is a start point. It's not the end point. And I think we've said that in the chair statement that we would keep it under review. It is what we feel we can afford today. It is in response to conversations that we've had with our many shareholders, and so the ambition would be to increase that over time. However, what I don't think we would either rule out would be, as the balance sheet does unwind, we'll go through this one-time period where we will have a significant cash on our balance sheet. I cannot preempt, obviously, what our board might decide as to whether or not there would be a one-off additional buyback or there would be a special dividend or something like that. Time will tell. But we see the 3 million as a start point, not an end point. And I think that there was one further question, which was a repeat of, essentially a repeat of an earlier question. And another very good question, which is, have you considered splitting the business into a fund manager and an investment trust to maximize shareholder value rather than pushing for an exit of 70% of the portfolio in short order?
Yeah, I hear what you're saying, and in effect, we're trying to achieve the same. It's a maturing portfolio. I think it's the first point. And the second point, it has very modest capital needs. So if you're going to go down that route, you're raising money, you're renewing a portfolio. We haven't added any new businesses now for 2 years, actually, to that portfolio. So we have really made the commitment to turn it into cash. And the reason being is actually we do have homes for that cash. We have bought businesses approximately every 3 years. And I would like to think within the next 18 months, there'll be at least one acquisition to come. We don't want to raise money on the city. We want to do that from our own resources, and the balance sheet will be a source of that. The other thing is that we are often an LP, a limited partner within our own managed funds. And as we look to scale the fund management operation, we will need cash resource to seed those funds as well. Typically, it's a 2% of the fund, so it's not a huge drain of cash individually, but it will be an important element of our growth prospect going forwards.
Thank you, Mark. Further question is, again, back to moving into the real asset space. Another good question, which is, how do you get into social housing or other real asset categories? Is that not big boys territory? That's another very good question. And the answer is, as we have done in the past, we will acquire our way in, because we started as a retail, an investor of retail money through our EIS funds. We then acquired Enterprise Ventures. That took us into institutional venture and into SME lending. We then moved into venture capital trust, where the check sizes were larger but still venture. And then with the acquisition of Frontier Development Capital, we moved into larger check sizes for SME lending, but then also into property lending. So the way that we have done that is to acquire the credentials and the people and the skills and the track records, rather than trying to start from zero. And so therefore we anticipate that our move into the real asset space will come via a careful acquisition. And I think there's a number of questions that have come in at the end, which are of similar to the question earlier on around the share price performance over a period, and also a question around are any of the direct investments, Mark, showing real traction? A somewhat skeptical question.
Well, I mean, context is we are in a downswing in the venture cycle, unquestionably, and we have been now for a number of years. Our venture businesses, so our balance sheet businesses, are demonstrating real traction, absolutely, but it's slower than we would like it to be. So we are doing everything we can to move that forwards. We have a model, for a number of you will know, we have an internal model of operating partners, venture partners, where we put resource from our own capabilities into those businesses, and we're doing those to help them in what is unquestionably a challenging environment. But that is why we are optimistic as we look forwards, because we can see, to put that into context, we've got 20-ish businesses on our direct investment portfolio, but we've got about 260 across the group. And when we look across the group, we are definitely starting to see green shoots within this area. So we are optimistic in the medium term, but I think at the moment it's about supporting these businesses to fulfill their ambition. And yes, a number of them are making material transaction progress. You know, we've got businesses in here growing 30% plus revenue year on year. So they are growing, many of them.
A question which is, what are your plans for the period after MERCIA 27?
Oh, ask me again in 12 months' time when we start to review for the next 3-year plan.
Yeah, more of the same, I would say.
I would, you know, we
on the main market, perhaps.
Well, we do it. We do. You know, I conclude the statement in the about going further and going faster, and that really means going bigger. And I think that if we can become larger, then we can move to main market if that is an option. But it is about growth. I do think, and somebody referenced the big boys place. It is about scale. We are into a scale industry now. So whereas 2 billion to 3 billion, yeah, that's great. But how do you get from 3 to 5? How do you get from 5 to 10? So it will be about growth and scale, and the continued thread on EBITDA growth and margin improvement as we look to benefit from scale advantages. So growth is going to be at the heart of the next 3-year plan, but I'm absolutely focused on delivering this one.
And I think perhaps a final question, which is around the performance of the various parts of MERCIA, and actually another somewhat skeptical question around whether or not the only decent part of MERCIA is the VCTs. What I'm happy to confirm is that every part of MERCIA is profitable. All of our asset classes are generating profits and cash. So no, it isn't just the venture capital trust that we manage. But thank you for that question. And that, I believe, is all of the questions that we received, and thank you very much indeed. I hope you feel that we've answered them all clearly for you.
Mark, Martin, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Mark, could I please just ask you for a few closing comments?
No, of course, absolutely. There are really 4 areas that we spend our time focused on and maximizing the performance of. So our employees, our team, we are really proud of these results. When you look at the environment that all businesses are operating at the moment, the volatility and uncertainty, our team has performed miracles in this. So our employees, our team are really important. That's one. The investees, so the deal origination platform that we have developed is scaling well, and we are confident we will get better and more opportunities to invest. So investees, our fund investors, this is about now scaling our sales and distribution. So fund investors, really important and a big drive actually over the next 18 months for us. But importantly, and a number of your questions have come to here, are our shareholders. And we're incredibly grateful for those that have supported us over this journey. And we are driven now to get that correction sorted out, because every presentation we do, which is frustrating and flattering at the same time, is people say you are worth more than your share price. So it is up to us now to make sure that that is corrected through too.
Mark, Martin, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of MERCIA Asset Management PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.